press the bell icon on the YouTube app and never miss another update.
See, in the earlier episodes, we had discussed how we can calculate the tax base of an asset and tax base of a liability. And then we were considering the carrying amount of the asset or the carrying amount of liability in the balance sheet. We were comparing that with its tax base. And the difference between the two we were saying is temporary difference. At that time, I told you that temporary difference is something that we'll be discussing later on. So finally, the time has arrived that we now understand what will be the treatment of temporary difference. Now, as far as Ind AS 12 is considered, temporary differences are classified into two categories. One is known as taxable temporary difference, and the other is known as deductible temporary difference. Okay, how shall I distinguish between the two? If it is a taxable temporary difference, it results into higher taxable profits in future, right? Higher taxable profit. That's the reason I call it as a taxable temporary difference. While this deductible temporary difference, it results into lower taxable profits in future. Right, we are discussing what will happen in the future. By future, we mean future assessment year. It may be the next assessment year or any of the other subsequent assessment years. So, if the taxable profit is going to be higher in future, I will say it is taxable. And if it is going to be lower in future, we'll say it is deductible. Okay, when does it arise? So, we say arises when carrying amount of asset is higher than the tax base. I'm writing on the other side. Or carrying amount of liability is lower than the tax base. Similarly, when will I have deductible temporary difference? Arises when carrying amount of liability is greater than tax base, or I'm continuing on this side, or carrying amount of asset is lower than the tax base. Okay, if it is taxable temporary difference, then we should recognize deferred tax liability, right, popularly known as DTL. And if this is the situation, then we should recognize deferred tax asset, right, very popularly referred as the DTA. Write this note a bit later. You have sufficient time. Use this time right now to understand in a proper way that what is the treatment of the temporary difference. As I was saying earlier also, there are two types of temporary differences. One is a taxable temporary difference. Taxable temporary difference means it will result into higher taxes in future. So in future I'll end up paying more tax. So maybe in current year you are paying less tax or maybe no tax, but in future you will pay more. If in future you are going to pay more, that means your tax liability is getting deferred. It is the payment of tax which is getting postponed in cash. The liability has already crystallized. So I should go ahead and recognize a DTL. While this is a situation where in current year I will pay more tax, but in future I will pay less. So it's a benefit that I am going to get. See, if in future I am supposed to pay less tax, that means I will save tax. Tax is a cash outflow, so I will save cash outflow. Saving a cash outflow is as good as a cash inflow. Cash inflow is nothing but a future economic benefit. Tell me, what is an asset? What is an asset? An asset is a resource that you are controlling which will give rise to future economic benefits. So this particular savings in tax I will recognize as a deferred tax asset in my books. Current year I will pay more tax, but I will tell myself that current you are paying more, in future you will pay less tax. That's where I will recognize a DTA. Let us discuss these situations with the help of illustrations and it will become more and more clear. Okay, let's take the first situation. You are saying carrying amount of asset is greater than the tax base. Now when will this kind of a situation happen? For example, the depreciation that you are charging in accounts is less than what you are claiming for tax. That's when you will have this kind of a situation. For example, let us say I have purchased an item of PPE. As per Ind AS 16, I am calculating the depreciation. Let us say I realize that the useful economic life of this item of PPE is, let's say, 15 years. So I will depreciate it over 15 years. And let's say I have decided to follow the straight line method. So that is how I'll provide depreciation in accounts. While when it comes to income tax, your accounting depreciation will be disallowed. You have to follow the block of asset principle under the Income Tax Act, and ultimately you are following the WDV method. So what happens in WDV method? Initial years your depreciation will be higher, subsequent years your depreciation will fall. And as such also the rates of depreciation in income tax are far higher than what you will be doing in your accounting books. So basically what happens in income taxes, there is accelerated depreciation. So what will happen? Think for a moment, what will happen? You are charging less depreciation in accounts, but you are claiming more depreciation in tax. Higher depreciation in tax in current year means lower taxable income. Again I am repeating if you have missed it out. In income tax, I will charge depreciation at a higher rate. So I will charge more depreciation in the current year. So when you are computing your taxable income for the current year, you will claim a higher deduction of depreciation for tax. Automatically your taxable income will reduce. Automatically you will pay less tax. But this benefit will not continue forever and ever. Because you follow WDV method in income tax, in subsequent years your depreciation will reduce. And that is the time where the income tax authorities will catch you, isn't it? Current year you claim higher depreciation. Current year you are reducing your taxable income. So current year you are paying less tax. But what will happen in future? Right, that's what we are discussing. What will happen in future? Your depreciation for income tax will reduce. And in future you will claim lower deduction of depreciation. Lower deduction of depreciation means higher taxable income. So I will have higher taxable profit in future, and that is the reason I will recognize a deferred tax liability. In current year I will save tax, but I'll tell myself that Ashish, there is no need to celebrate over here. Current year you are saving tax, but in future you will end up paying more tax. So the liability of paying tax in future has already crystallized. It is only the payment of tax in cash which is getting postponed. So Ind AS 12 says go ahead and recognize the deferred tax liability. One more possibility, think of it. Carrying amount of the asset is higher than the tax base. Let us say you are doing some upward revaluation of an item of PP. We know that under Ind AS 16, even under Ind AS 38, you are having two models of accounting for the fixed asset or the tangible fixed asset as well as the intangible fixed asset. I can follow the cost model or I can follow revaluation model. So let us say I have done upward revaluation of an item of PPE, or let's say I have a building and I have done upward revaluation. This revaluation will not be recognized under the income tax. So the value of the asset will increase in my accounting books, but it will not increase in taxation books because income tax does not consider revaluation. So this is one more situation where the carrying amount of asset will turn out to be more than the tax base. For example, let us say building right now is 10 lakhs at both the places, let's say. And now I am doing an upward revaluation of, let us say, 2 lakhs of rupees of building. So in my accounting books, the building is 12 lakhs. But in income tax, it will still remain 10 only because income tax will ignore the revaluation. So again, I have a situation where the carrying amount of asset is higher than the tax base. Isn't it? So what will happen is this revaluation gain which I am showing in my books, this revaluation gain is not going to be taxed in income tax. So I will not have to pay any taxes on it right now. But in future, whenever I will sell this building, at that time there will be a gain. Think of this way. The building is 10 lakhs right now. Let us say the cost of the building is 10 lakhs and in income tax also it is 10 lakhs. Now I am doing an upward revaluation of building and making it 12 lakhs in my books. So in accounts it is 12, but in income tax it is still 10. This building of 12, let's say I am selling for 12 lakh 50,000. So as far as my accounts is considered, I have to now consider only gain of 50,000. Gain of 2 lakhs was already recognized in revaluation gain. Now I have to consider only the balance 50,000. But in income tax, 12 lakh 50,000 sale proceeds will be compared with 10 lakhs of rupees because the tax base remained undisturbed at 10. So at that time in income tax, there will be a gain of 2 lakh 50,000. On this gain of 2 lakh 50,000, you will have to pay tax. That's what we were discussing earlier. It will result into higher taxable profit in future. So as far as accounts is considered, the gain of 2 lakh 50,000 is recognized in installments. First 2 lakhs in the revaluation reserve and then the final balance 50,000 extra gain. But because 2 lakhs was not considered in income tax will consider entire 2 lakh 50. So entire 2 lakh 50 will become a part of my taxable profit and I will end up paying a higher amount of tax on it. So I should go ahead and recognize a deferred tax liability. Similarly, as you can see, the other possibility is where the carrying amount of liability turns out to be less than the tax base. Now, when will this kind of a situation arise, right? We are discussing illustrations. This would remain very theoretical. We have to understand with help of illustrations that when will the carrying amount of liability turn out to be less than the tax base and will give rise to deferred tax liability. Let us say you are acquiring another company. Let's say company A is acquiring company B. Now we have not done the Ind AS relating to business combination, but you are very much aware about the principles of amalgamation of accounting standard 14. So you may try to understand this with reference to AS 14. Now when we are taking over company B, I can record the assets and liabilities of the transferee company at its fair value. So let us say there is company B and company B is showing debentures. Let's say it is showing debentures of 10 lakhs of rupees. But when A is negotiating with the management of B, A suggests to the debenture holders of B that see we will take over your debentures but we will pay you only 9,50,000 on the date of maturity. Let's say the debentures are becoming due 5 years from now. So what you are telling the debenture holders of B is that we will pay you only 9,50,000, we will not pay you 10 lakhs. So we'll pay you 50,000 rupees less. Let's say the debenture holders of company B are agreeing for it, let's say. So they are agreeing for it. Now what will happen? When I will incorporate these debentures in the books of A, the carrying amount of the liability, that is the carrying amount of the debentures will be its fair value, which is 9,50,000. So I'll recognize 9,50,000 over here. But as far as income tax is considered, the debentures under income tax will be still recorded at 10 lakhs only. Income tax will not consider that the fair value of the debenture is 9,50,000. So in income tax also I change it to 9,50,000. That will not happen. So as far as the tax base is considered, the tax base will remain 10 lakhs of rupees only. So my carrying amount of liability will be the fair value, 9,50,000. But this fair value will not be considered for the tax. Income tax authorities will argue that what is the debentures in the books of B? I say it is 10. I have to continue with 10 lakhs only as far as income tax is considered. So what will happen? This reduction of 50,000 in the carrying amount of liability is not considered for income tax. But in future, in our original illustration, 5 years down the line, after 5 years down the line, you will repay the debentures. And at that time, you will not pay 10 lakhs. You will pay only 9,50,000. This 50,000 rupees that you are saving will be treated as your income in the year of redemption. Finally, the tax authorities will argue that, see, your liability was 10 lakhs. You are extinguishing a liability of 10 lakhs only by paying 9,50,000. 50,000 rupees less that you are paying is actually an income. And on that, the income tax authorities will levy tax. So what will happen? Current year, I will not be paying higher tax, but in future, my taxable profit will increase. And because my taxable profit will increase, it will give rise to a deferred tax liability. The concept of DTL is that you will end up paying more tax in future. Again, I will repeat, future does not mean the next year. Future means next year and also the subsequent years. So there will be a time in future where you will be liable to pay more tax. That's where I recognize a DTL. Finally, what should be my accounting entry to recognize the DTL? Of course, DTL is a liability, so naturally the liability account will be credited. So my accounting entry naturally will be to deferred tax liability. What will I debit? You will debit profit and loss account or other comprehensive income account. So either it will be profit and loss account debit to DTL or it will be OCI account debit to DTL. So DTL of course will be credited, but P&L or OCI, any one will be selected and that is going to be debited. If it is an item which is to be considered in profit and loss, then I will debit P&L. And if you are recognizing DTL on an item which is usually shown in other comprehensive income, then the other comprehensive income account is required to be debited. For example, earlier we were discussing about depreciation, that depreciation is higher for tax but it is lower for accounts. Depreciation is debited to the profit and loss account. So when I recognize DTL, I will say profit and loss account debit to DTL. Then we even discussed a point of upward revaluation of the fixed asset. If I do upward revaluation of fixed asset, then also the carrying amount of asset will increase. So if there is an upward revaluation of the fixed asset, we know that the revaluation surplus cannot be transferred to P&L. The revaluation surplus has to be transferred to OCI. Since this item will be transferred to OCI, any deferred tax liability relating to it should be debited to OCI. So item to item, case to case basis, you have to decide whether the P&L is going to get affected or the other comprehensive income is going to be affected. Let's see on the other side now, we are saying it's a deductible temporary difference. Deductible temporary difference means in current year you might be paying more tax, but in future you will pay less. And that's the concept of a DTA. When will it arise? When the carrying amount of liability is greater than the tax base. Let's take an example over here. Let's consider a section 43B item. Section 43B, it's a provision in the Income Tax Act where certain deductions are available only if you have paid that in cash. For example, we had taken this earlier also, a contribution of employer to the EPF. Now, as an employer, you will get the deduction only if you are paying that in cash on or before you file your income tax return. Now, let us say there is a contribution of, let us say, 10 lakhs of rupees to be made to the employer's provident fund. So, on accrual basis, I have accounted for it in my books. So, I do have a carrying amount of an outstanding liability. But as far as income tax is considered, because I have not paid that in cash, I will not get deduction for the same. So let us say I am showing 10 lakhs of rupees as employer's contribution to the EPF recognized on accrual basis. When I compute my taxable income, it will be disallowed. The moment it is disallowed, your taxable income for current year will increase and you will end up paying more tax in current year. But in the next assessment year or years, whenever you will pay that in cash, you will get a deduction for the same. That's the reason we are saying deductible temporary difference. I'll get a deduction for it in future, right? And the moment I will get deduction for it in future, I will save tax in future. And because I will save tax in future, I should recognize a deferred tax asset. Asset means I'm going to get a future economic benefit. And what's the future economic benefit here? Savings in tax is the future economic benefit over here. So I will recognize a DTA on this particular item. Yes, the other possibility is, yes, if the carrying amount of asset is lower than tax base. Okay, when can this kind of a situation occur? Carrying amount of asset is lower than the tax base. One possibility, of course, is you may have done downward revaluation of the asset. Here we were taking upward revaluation, but possible I have done a downward revaluation of asset. Now, downward revaluation, actually revaluation of any kind is not going to be recognized in the income tax. So you may have done a downward revaluation. So there is a loss that you are booking in accounting books, but that loss will be disallowed as far as income tax is considered. And that is the reason my taxable income for current year will increase. But in future, whenever I will sell that asset actually at a loss, then that loss will be allowed as a deduction. And that is the reason in future I will save tax. Why? Because in future my taxable income will turn out to be lower. Or think in lines of Ind AS 36, let's say. Ind AS 36 deals with impairment of assets. Let us say you are providing impairment loss. Let's say I provide an impairment loss of 50,000 rupees. The moment you will provide impairment loss of 50,000, the carrying amount of asset will reduce by 50,000. But impairment loss is only a provision. Provision will be disallowed. Provision for loss will be disallowed for income tax. So in income tax, the tax base will not reduce by 50. So here the tax base is reducing, the carrying amount is reducing by 50, but it is not so as far as income tax is considered. So you will debit your P&L by impairment loss, but this impairment loss will be disallowed. You will not get any deduction for it. Automatically the taxable income of current year will increase. Again in future, whenever you will sell the asset and suffer the actual loss, then that entire actual loss will be claimed as a deduction as far as Income Tax Act is considered. So in that year, I will save tax. So that's the same thing that we are saying. Results into lower taxable profit in future. And accordingly, we will get this kind of a situation. One more example. Let us say you have made an investment in debentures. You have made an investment in debentures or an investment in bonds, right? And let us say you have classified that as fair value through other comprehensive income. So I have made an investment, I classify that as FVOCI. I'm talking about Ind AS 109 right now. Financial instruments. In case if you have not done financial instruments, just hear me out what I'm trying to say. So you have recognized this as, you have classified this as fair value through other comprehensive income. And let us say there is a fall in the value of my investment. So my investment value has reduced. But that will not be considered for tax. Taxation normally considers the cost of the investment rather than the latest fair value. So what is happening is there is a reduction in the value of my investment which I am providing in my books, but it will be not recognized for income tax. But yes, when I will actually sell that investment and actually suffer that loss, then that loss will be considered for income tax. So again in that type of a situation, I will be saving tax. And because I will save tax in future, I will recognize a deferred tax asset. Finally, the question is, what should be my accounting entry be? Isn't it? Your accounting entry, deferred tax liability was credited because it's a liability. This is an asset. So deferred tax asset account should be debited. Right? I'm creating an asset in my books. To what? To profit and loss account or OCI account. If the item is affecting the P&L, then credit the P&L. If the item is recognized in OCI, then recognize the DTA also through OCI. The last example that we had taken where the debentures, where the investment in debentures was classified as FVT OCI. So you are taking the fair value to other comprehensive income. Then on that, if you are recognizing DTA, then the DTA should also be recognized in the OCI account. So the fair value loss will be debited to the OCI while the corresponding DTA will be credited to the OCI. So that is the accounts that it is going to actually affect. So this is in proper details. What do we mean by taxable temporary difference and the deductible temporary differences? I will request you to pause the video here and you can write this as a note.
Yeah, do write this note in your notebooks. And then in the next episode, we will discuss what are the conditions for recognizing a deferred tax asset.
Press the bell icon on the YouTube app and never miss another update.